Welcome to episode 13 of the ICT Mastery Mentorship. And just so you know, I'm recording at 1:15 a.m. I'm not even supposed to be awake right now, but anything that you to get this thing finished. Okay, this is ICT Mastery Mentorship. Let me show you what I have left for this chapter. Let me show you. I have about this much left. Okay, and today we're going over ICT Killzones. Right there. We're going over the Killzones today. Anyways, enough of that gibberish. Let's actually go over the kill zones. Now, there's 3 different kill zones, okay? There's Asian, London, and New York, okay? Asian is the lowest volatility, London is the second highest volatility, and New York is the highest volatility, okay? These kill zones are times and price, where price is, I guess you can say, way more volatile, okay? Or where the algorithms are higher, basically more active, okay? Or you just to keep it simple, they're basically times in price where price is more volatile or more active, okay? So that's just a simple definition or version of it, okay? That's just very, very simple. We're going to go over some setups that forms in each one of these sessions, okay? So you can get the gist of it and you know how it works. Because there's certain sectors when it comes to certain sessions, specifically New York session, okay? There's really three parts. There's AM, lunch, and PM on here, but we're not going to start with that now. First, we're going to start with Asian, okay? Asian, out of the 3, has the lowest volatility out of the 3, okay? Out of the 3, remember, has the lowest volatility out of the 3. Not saying that it's not volatile, because out of session, if you look outside of these times, price is kind of volatile, but once that time kicks in, from Asian, London, and New York, you can see how price gets more volatile. You can visually see it, like you can see it right in front of you. You can literally see it. But if we look at Asian, you see as soon as Asian kicks in, it starts moving. See that? And as soon as Asian ends, it kind of slows down. See that? Pretty cool. It literally slows down right in your face too. Even though this is hindsight, you can still see it pretty well within hindsight because you can see the playback or the history of candles just from the way they opened and closed, and the wicks obviously. But looking here, as soon as Asian came in, price started moving. So up, down, back up, Asian closed, and then it slowed down. Okay, so that's what the kill zones are. Okay, and you would rather trade in these kill zones. Okay, you can either trade the London kill zone or the New York kill zone. Okay, or the Asian kill zone. I'm not saying you can't trade Asian. You can trade Asian, London, and New York. It doesn't matter. And there's certain profiles and certain models and certain specific procedures that you can use for each session. And I'll be teaching you that probably around in chapter 3 or chapter 4, around those areas. The procedures for each ICT kill zone is like I said, 3-4 chapters from now, because there's different chapters to this mentorship. But like I said, Asian is the lowest volatile out of the 3. London is the second highest volatile. New York is the most volatile out of the 3. Okay, I'm not saying Asian isn't volatile. I'm not saying it isn't volatile. It is the least volatile out of the 3. Okay, so you have Asian, London, then New York. New York being the highest volatile. Okay, so New York is the highest, London is the second highest, Asian is the third highest. Simple, right? And you would want to look for trades within these kill zones. Okay, this is where you want to look for your trades. You don't want to look for trades in between these little gaps here, okay? In between these little gaps and in between these kill zones, you don't want to look for trades there, okay? You can probably analyze these gaps in between the kill zones. You can analyze them, yeah, sure. You can look to see what's going on for confluences, but don't trade them, okay? Trade within these here, within these right here. You're gonna get a more in-depth definition and understanding of what these kill zones really do, because yeah, they do help you, but they do provide more, I guess you can say, higher probability trades within these times, yeah, but there's a deeper meaning behind these kill zones. Way deeper, okay? Way deeper. It's not just, oh, price moves faster than this time. Each session has a purpose, okay? We're not going to go too deep into that. Not too deep into that. But looking here, okay, I'm sure you learned about liquidity purges and liquidity runs and fair value gaps and, all that within this chapter so far. So let's just go on and on what happened during, Asian session. So looking here, we have this one run. We have one run higher and then one run lower. Okay. So if we look, we have a run above where? Buy side liquidity right here. So this would be your liquidity purge. Okay. Like I said, anything can be a liquidity purge to you if you know what you're doing. If your narrative is correct and you have everything down pat, your liquidity purge can be this. Okay. And this might be a liquidity run for somebody else. Hey, it's all based on your narrative, okay? Well, for example, let's just say your narrative is bearish, okay? You're looking for sell a sell opportunity during Asian, okay? Then this might be your sell opportunity. We have a liquidity purge at these highs here. Price comes up, comes back down, creates a bearish fair value gap. Price comes into it, but does it respect it? Does it like want to resist off of it? Yeah, it pushes through it. It does. It pushes through it. But does it eventually, come back down? Have some willingness to go lower? Yes. Where are you targeting though? If you would have took this fair value gap and entered off of it, where are you targeting? Down here or that low there? Okay. Let's say you target it right there. That's your point of sell side liquidity. Right along there. Okay. So I'm going to be going over some examples within these kill zones to show you the high probability setups that form, okay? And no, you don't have to use strictly the 5-minute. I'm just showing you examples. I'm showing you previews, okay? I'm not going to say thousands, but there's hundreds of different setups you can find. Hundreds. There's hundreds, maybe thousands, but there's hundreds of different setups you can find in these kill zones or these specific times and price, okay? I'm not saying, oh, look for a liquidity purge, look for a fair value gap, and then look for point of sell side liquidity. No. Don't look for just that, okay? Because there's going to be more you're going to learn. There's going to be more, but I'm just giving you examples based off what you know, okay? Well, in this mentorship, we're sharing the same knowledge, okay? You don't know no more than me. I don't know no more than you, okay? We know the same exact thing. Okay, I don't know what the heck IPTA is. I don't know what IPTA data ranges are. I don't know what central bank dollars ranges are. I don't know any of that. Okay, I do, but in this case, I don't, because I'm teaching you. I need to get the mindset as if you are a completely new student and you have no idea what the hell I'm talking about. That's what I need to get into. Okay, so I'm doing this purposely, and I'm doing the stuff that you know. Okay, until we get to chapter 3, chapter 2 of this mentorship, then I can start doing more and showing you a lot more things. But until now, all you know is liquidity purchases, liquidity runs, and fair value gaps in the market efficiency paradigm. That's all you know. That's all you know. Anyways, going back into it. Price came up to that fair value gap. There's your sell right there. Right along there, once price comes into it, and your stop is right there at that high. Drag it down to the low. That would provide you a pretty nice trade, okay? And also with the fair value gaps, okay, let me go over one thing with the fair value gaps. Zooming in on this one here, okay? Like I said, a fair value gap forms with 3 candles, okay? 3 candles. Right? I need you to understand that. Forms with 3 candles, okay? So it's 1 right here, 2 right here, and 3 right here, okay? For a bearish candle, it's the low of the first candle, okay? And then it's the high of the third candle, okay? If you are taking a trade off of a fair value gap, right, and you expect the fair value gap to be respected, you would either place your stop at the high of the second candle or the high of the first candle, since it's a bearish fair value gap. But if this was a bullish fair value gap, for example, say you're taking, if I can even find it, let's say you're taking this one here, you would set it at the low of the second candle or the low of the first candle, okay? Well, whatever you prefer, whatever you can actually do, okay? Whatever you're more comfortable with, okay? It can be the low of the second candle or the low of the first candle, okay? For bullish scenarios, but for bearish, it'll be the high of the second candle and high of the first candle, okay? Because if you have it at the high of the third candle, you're getting stopped immediately. You're not even gonna have a limit order. It's stupid, right? So you have to have it at some logical place, so price will stop you out. A good stop loss to where it's not too much risk, but it's enough to where you're comfortable with. Okay, just a little clarification on fair value gaps and how you can really use them for your stop losses. Okay, but taking that effort, right, you got that point of sell side liquidity would have been your nice little entry. Okay, not little entry because that was a pretty good entry right there. Just having that effort right gap and selling price off. This pretty good trade, honestly, really good trade. But let's go into London session now. Oh boy, this is a lot of chop. Holy, just looking at this back and forth movement, it's a lot of chop. My goodness. All right, so we came back during London, right? We came back into this old high. Along here. What's that? Buy side liquidity. So price came up there, closed below it, showing a willingness to go lower. To go lower into what? What exactly? This sell side liquidity down here, or these relative equal lows. Okay. And when it comes to relative equal lows or relative equal highs, whenever you see that, it's more of a key point in price. Okay. It's a more of a key level of liquidity. Whenever you see relative equal lows resting or relative equal highs resting, that's a key point of liquidity that price may come and hunt later. So price comes down into sell side liquidity. We purge it. How? Let's look. We're showing a willingness to go higher. We dip down and close higher. Bodies are telling us we want to go higher. We have displacement higher, showing us I want to go higher. We displace away after, manipulating into this low. So we manipulate down into sell side liquidity, and then we displace away. Okay. Well, where's your entry at? Where's your entry? Let's see, we can probably drop into a 3-minute. You most definitely see. Around here somewhere. Yep. There's your entry right there. At that fair value gap. There. If you know price is going higher, hey, take it. There is your fair value gap right along there. And if you pay attention to it, it also shows that price wants to go higher off of that fair value gap. Because look where the body's closed. We came into it. Yeah, the wicks did the damage. But where was the closing price? It was right above it. It didn't even close inside of it. It closed above it. So that shows it wants to go higher. And that would have been your entry right there. I'm sure you could have took a lower time for fair value gap around here in this area, like right along this canvas area, because you can see the little retracement down. But that fair value gap would have been a pretty good entry. Because if we, practice what I just taught you, okay, our long position right there, you can have your stop. I normally do the bottom of the low of the first candle, just to keep it safe and comfortable for me. That's what I personally like doing. But it's not based off of me, okay? It's based off of your preference. Pull this out, and what could you be targeting? Let's jump back onto the front end. What could you be targeting? And there really is no point to target. Oh, you can target those relative equal highs there. See that? I just mentioned that relative equal highs are a key point for price. I just mentioned that, didn't I? Just mentioned it too. I literally just mentioned it. Boom. 4 risk to reward right there. Beautiful. And there's that fair value gap on the 3-minute time frame. Right there. There's that fair value gap. Okay. I'm going to be teaching you how to use not fair value gaps, but time frames more in a versatile way, because you don't know how to use time frames yet. Okay. There's things called not time frame, but top down analysis. Okay. You will learn that in the end of the chapter, in this chapter. Okay. Because I'll show you. Matter of fact, let's go to my Dropbox, and you see this down here. Those are the end of chapter lessons, okay? The end of chapter lectures. Like I said, these are going to be about 30 to 40 minutes long because it's a real lecture. It's not just, this, that, and the other. It's literally like a full, in-depth lecture. These topics, okay? Time frame selection, defining setups, top-down analysis, and, understanding price. And I still cannot believe it is 1:30 in the morning I'm recording this. That just shows the amount of dedication I have when it comes to, providing content and providing knowledge to people that need it. But anyways, that's that fair value gap on that 3-minute time frame. You took it as soon as it came into it, and bang, there's your trade right here. Stop loss with a 4.4 risk to reward. Hey, pretty good, isn't it? Moving on to New York session. All right, let's move on to New York. All right. So looking here already, I just had voice crack. Jesus Christ. Looking here already, we can see that we had this little run before New York, okay? Run into what? Old high. Right there. Old high. Right there. So that's 2 points of buy side right there. Did it reach into that high? Barely. Kinda. It's gonna reach into that later though. Promise you. Did it do it? Yep, it did. It did. Anyways, going into the actual example, after price took out that high and you see it close below, you can immediately jump to a lower time frame to really see what's going on. So let's jump to the 1 minute. Well, price had a really aggressive reaction off that high, so there really would have been no entry based off what you know. There, I do see an entry here. There is an entry around here, but based off your knowledge, there is no entry. Okay, and that's fine. Totally fine. If there's no entry, there's no entry. You can take another entry later and look around. We jump back on the 5 minute. Price come back to that high, closing below it, showing that we want to go lower. Lower into what? This low here. This point of sell side liquidity. And you can see that price wants to go higher if you guys look at the candles. Dip below liquidity, close above. Dip below liquidity, close above. Dip below liquidity, close right at it. Okay, so that's showing that we want to go higher. You have this one impulse candle, bang, back up. We create a fair value gap, showing that buyers are here. Okay, that's where your entry is, right there at that fair value gap. Should I draw it? Yeah, sure. That's your fair value gap. When price comes into it, that's your long. Right along there. You say your low, not your low, but your stop right there at the low of the first candle, and then target where? This point of buy side right there. That right there. Bang. Beautiful. That's truly beautiful. So all we did was use a point of sell side. Plus liquidity purge, yep. So it was two liquidity purges leading into another. So this liquidity purge up here, and then a willingness or a confluence closing below these highs here, showing out that we want to manipulate lower into what? This low here, causing a liquidity purge. You see a impulse move higher right here, bang, creates a fair value gap. That's your entry right there. How? This liquidity purge, and the way price is moving around here is telling you that price wants to go higher. So that fair value gap is safe to take. Okay, according to what you know. Okay, according to what you know, there's more to learn. But according to what you know right now, that's a good fair value gap to take. Did price push higher into that high? And did you take profit? Yep, sure did. Sure did. Amazing, isn't it? Truly is amazing. But anyways, I think this is the end of this episode, episode 13. I think I'm just repeatedly recording whenever I can. I'm starting to forget the episode numbers. I think there's episode 13, 14. But anyways, enough for me talking. This is the end of this episode of the ICT Killzones, and I'll see you on the next one. Peace.